The US dollar has started this new week lower once again. So in today's video, let's look at what we can expect from the US currency over the coming weeks as we head into the end of 2023 and the beginning of 2024. Hello and welcome back to our channel. My name is Daniela. And in this video, we will be looking ahead at the US dollar performance, what we can expect on the economic calendar in the coming weeks. Of course, looking towards that end of the year Federal Reserve meeting and how the US dollar can perform heading into that. Before we get into this video, please like, comment, subscribe, and turn on your notifications. So the US dollar has seen some interesting performance throughout the year so far. It's been overall a pretty good year for the currency. We've seen some strong moves from the US dollar, especially throughout the summer months, starting in July, heading up towards those highs that we saw roughly about a month and a half ago. Of course, a lot of that alongside a rapid rise in US yields, but that momentum has quickly reversed. We have seen some strong weakening from the US currency, mostly on the back of softening US data. So let's quickly review what we have seen in terms of the economic data, which of course we know has been one of the main drivers behind the Federal Reserve's monetary policy and also one of the key drivers behind the US dollar momentum. Now, we saw the US jobs data for the month of October. We saw weaker NFP data, and that of course prompted this move towards a weakening in the US dollar as it set up expectations that US data was starting to turn. We're starting to show a softer US economy. We're starting to show a different picture to what we'd seen up until that moment. Throughout all of 2023, we've seen some remarkable resilience from the US economy, showing strengthening economic growth and very resilient and tight labor market, consumer inflation continuing to rise throughout most of the beginning of the year. We then saw a turn towards the latter part of it, but inflation still remaining high. And all of that was driving the moves in the US dollar and driving the Federal Reserve's mandate of keeping interest rate high, of hiking interest rates throughout the month to make sure that their dual mandate to achieve stable inflation, but also stable growth and labor market was being met. So we have seen those continuous rate hikes, about 500 basis points of tightening since the cycle started just over 18 months ago. Most of that strong data was driving that hiking cycle. At some point, markets knew that would have to change, and that weakening in data that we've seen over the last 6 weeks has started to change that rhetoric and really lead markets to price in when rate cuts are going to happen. Following the US softer US jobs data, we saw the CPI data coming out below expectations. Headline CPI coming down to 3.2. It's not the lowest level we've seen in the last few years since the pandemic brought on that rapid rise in inflation. We did see it drop to around 3%. I believe back in June, it picked up once again throughout the summer months, but it's now back to 3.2%, below expectations. Core inflation actually was expected to remain unchanged. It managed to drop marginally, the yearly figure coming in at 4%. Continuing that decline in core inflation and also a 2-year low for that figure. So again, weaker data from the inflation side. PPI also came out below expectations. So although at no point does this indicate that the US economy is in trouble or that a strong recession is coming, it does start to turn the picture in terms of a strong and resilient labor and market and economic growth. We're starting to see potentially the end of the tunnel of that, starting to see that weakening in data. Now, bear in mind that we have seen the GDP figure for the third quarter actually coming in higher than expected. The quarter-on-quarter growth for the US economy in the third quarter came in at 4.9%, above expectations of 4.3% and rising strongly from 2.1% in the previous quarter. So that does contradict this weakening data a little bit, but nonetheless, markets are focused on that softer inflation and softer jobs data. And they've started to think that this is the end of the line for the Federal Reserve in terms of hiking, that from here on out, there's going to be rate cuts coming pretty soon. Now, prior to this data, we weren't expecting to see rate cuts until the end of 2024. That has now come forward with the first rate hike expected in the second quarter, somewhere between April and May. In terms of the full year, markets are now pricing in roughly about 100 basis points of cuts by the end of 2024. And that has shifted a lot since, as I said, we've had this weakening data. Now, in terms of are markets jumping the gun? Are they pretty in line with Fed expectations? I would say markets tend to overreact once we start to see that shift in momentum, because we've gone from throughout most of 2023 so far, this very, very stern, hawkish view of having to keep rates elevated and making sure that inflation doesn't pick up. And as we saw throughout the summer, it's not a linear process. The disinflation process can go down, it can bounce back up. There's many factors affecting this, whether it's energy prices, whether it's wage pressures. So we've seen this perception of wanting to remain very, very hawkish. Now markets are expecting the Federal Reserve to be like, okay, we've seen enough tightening. The data has definitely shown that the economy is cooling. So let's start to talk about rate cuts. So even just that feeling and that talking about rate cuts coming would really shift that mentality in markets and would definitely have an effect on the US dollar. Now, we do have some more data coming out before the end of year Federal Reserve meeting. We'll have another labor market reading, and we'll also have another CPI reading. That will actually come the day before the FOMC meeting. FOMC meeting is scheduled in for the 13th of December. Now, in terms of that meeting, likely nothing's going to happen there. 100% chance of no rate hikes priced in at the moment. I think that's pretty fair. Given the data, it's highly, highly, highly unlikely that we would see the Federal Reserve hike rates again. But all the messaging we've had from FOMC members is that despite the economy moving in the right direction, it's too soon to lift the foot off completely from the tightening cycle. That doesn't mean that we're going to see cuts immediately. It doesn't mean that the economy is in a dire situation and needs to be rescued. So far, it looks like a soft landing has been achieved, where inflation is coming down, but growth is remaining somewhat resilient. I think the GDP data shows that alongside the softening CPI data. But I think the Fed will want to avoid cutting too soon, because that can create grave consequences further down the line for the economy. So I think at the end of year meeting, we see the Fed acknowledge the softening data. We see the Fed accepting that there are likely no more rate hikes in the near future, which would be a shift in the messaging that we saw in the previous meeting. But I think it's unlikely at this point that they really start to consider those rate cuts. They might talk about when they forecast them to start, and we may see that fall roughly in line with our market expectations, but I think they will be still pretty adamant on not wanting to give in to the fact that it's going to be cutting from here on out, which is something that markets at some point are expecting. So there is quite a bit to go from here on to the end of the year. As I said, markets continue to be very, very data dependent. You only have to look at the charts on the days that the softer jobs data came out or the softer CPI data came out, just the reaction we saw specifically in the US dollar. So it's likely going to remain very data dependent. Of course, we have geopolitical events going on. We have still tensions in the Middle East. We have ongoing talks between China and the US. We have a presidential election coming up soon. So there are some macro factors to keep an eye out for. But for now, in terms of data, I think we may continue to see the US dollar softening on the fact that it looks like this data could continue to show a somewhat softening economy. Let's jump onto the charts now to see how the US dollar has been performing. Okay, so let's kick it off with the US dollar index, just so we can see how the US dollar has been performing, and especially on those big data days that I've been saying. Here on the 14th of November, we saw that weaker than expected CPI. On the 3rd of November, that weaker than expected jobs data. And you can see just how strong the bearish momentum was on these days. And one of the key drivers, not only behind the Fed's mandate, but also behind the US dollar moves. After those big move days, you can see we've had some attempted consolidation higher. Again, that's normal after these moves. We also have to keep in mind that the US dollar does play its big part as an international currency, also as a safe haven asset. And We do have some geopolitical events going on that traders will keep an eye out for, and that has potentially been attracting some foreign investment into the US dollar. But the day-to-days have been really, really important, and I expect them to continue to be in the short term as we head into that final FOMC meeting for the year. Now, there's one concept that I quickly just want to mention because it's important to know, and that is the US dollar smile. Now, not everyone believes in this, but theoretically, this says that there is two scenarios when the US dollar outperforms versus one when it underperforms. The two where it outperforms is when there is high risk aversion. So there is a shaky global landscape and investors buy US dollars to trade or to invest in US treasuries, which are considered a safe haven asset. Or the other scenario is when there's strong US fundamentals, then investors buy the US dollar. Conversely, the one when it underperforms is when we have weaker US fundamentals, potentially rate cuts coming up. That is when the US dollar underperforms. Now, this somewhat fits into what we've been seeing throughout most of the year. We have seen strong fundamentals from the US, despite forecasts at the end of last year forecasting a very dire situation this year and a strong recession. The US economy especially has shown some strong resilience. The labor market has, the inflation picture has. In terms of markets, the stock market has shown incredible resilience. So that has aided the US dollar higher throughout most of the years, accompanied by the US yield. Now, we seem to have come to that point where the fundamentals are weakening. We're now considering rate cuts. We're looking as to when that rate cut will come, how many will there be, to what position or to which level rates need to come down to in order to have a stable dual mandate in terms of inflation and growth. And that seems to be bringing in some weakness to the US dollar. But there is another side to this that generally brings US dollar strength, and that was when there is high risk aversion and investors flock to safety, like in the US dollar and US treasuries. Now, I'm not saying necessarily that this has to happen, but it is something to keep in mind, especially we're looking at the longer term, especially the beginning of 2024. If this weakness in the US dollar continues, and I think in the short term, this bias is going to continue to be bearish, I think it's something to keep an eye out for, is that if we do start to see this weakening in data that is actually really good now globally because it's allowing central banks to soften their mandate, if it does start to come into a little bit of a situation where it's spiraling into real economic damage, then we may see investors flock to safety and therefore the US dollar picking up some momentum once again. So this is more longer term, but something to keep an eye out for in the coming months as the data evolves. For now, as I said, there is a short-term bearish bias on the US dollar, expected to see weakening data heading into that end-of-year meeting where the FOMC is expected to keep everything unchanged, but potentially start to highlight rate cuts at some point throughout the next 6 months. Doesn't necessarily mean that the Federal Reserve is going to say right now, we're cutting, this is how many cuts we're going to do. In fact, at the last meeting, they were still talking about potential more rate hikes coming in. Of course, with the latest data coming in below expectations, that is highly unlikely to happen. But with the FOMC expected to start cutting rates at some point next year, it looks like the bearish bias could continue in the short term. Let's take a look at one of the key pairs for the US dollar, which is euro, one of the key components of the dollar index. And you can see we've seen euro dollar strengthening significantly throughout the last month. Also on those big data days here, the 3rd of November and also the 14th of November, as we saw that jobs and CPI data coming in weaker than expected. We saw the euro really taking advantage against the dollar side. It's been very, very one-sided at this point. We do have the ECB and European data coming in on the euro side. And of course, that is important on the calendar. And we'll have the ECB meeting in mid-December as well. But for now, it looks like it's been very, very dollar dominant. And of course, that weakness allowing the pair to move higher. Now, as I said, in the short term, there continues to be a bearish bias in the dollar, which allows a bit of a bullish bias for euro dollar. I wouldn't be surprised if we breach towards 110 over the coming weeks, heading into the latter part of the year. But one of the things to keep an eye out is I think it is a pretty healthy rally that we've seen. And you know me, this is something that I tend to highlight. But when we see pullbacks after days of strong moves, that tends to indicate a healthy rally. It tends to indicate sustainability within the move because we do see sellers challenging that rapid rise. And, we do see buyers outperforming and showing their dominance. And I think that alludes to more healthy moves higher. Now, the RSI is showing overbought conditions, and I think the rally does tend to get a little bit overextended. So I wouldn't be surprised if we see some sideways consolidation, especially now that we've breached the 109 level since the last, since August, which was the last time that we were there. But as I said, it looks like in the short term, the bias continues to be to the upside. 110 is, I think, an attainable target for the next coming weeks. That is it for today's analysis on the US dollar. Thank you so much for watching, and don't forget to subscribe to our channel.